Hey there, YouTube. Dr. Stock here, Doctor of Education, and we need to talk about the CPI that is coming up on Tuesday, February the 14th. I do not believe that is going to show us any love, and I am not sorry about the bad pun for Valentine's Day, although I do hope that you have an incredible Valentine's Day. I put out a Patreon exclusive about the historical analysis of the CPI and just how significant some of the consensus values that we have for the CPI are, along with the historical analyses themselves leading up to everything through December of 2022 and then projecting for January 2023. Like I said, that is available over at the Patreon. You can find that link down in the description. I'd absolutely love to see you over there. Come on over, be part of the community, and you get access to my services, my products, and also the private Discord that's over there as well. So if you'd like to find out more, check out that link down in the description. Let's move on to the market impacts that we could see as a result of the CPI that's coming out on Tuesday. So the CPI, which is scheduled to be released at 8:30 a.m. on Tuesday, February the 14th, for month over month for all items, for all urban consumers, 0.5 month over month. And I know that doesn't sound too significant. However, when you annualize it, when you multiply it by 12 to see what that would look like stretched across the entire year, you're up to a rate of inflation of about 6%. And I do not think that the market is going to react very kindly to that. And that's assuming we come in at expectation. That does not account for coming in above expectation, which I believe would be absolutely calamitous to the markets and would revisit some of those lows that we saw, just over a month ago prior to January's run up. So we really want to keep an eye on that as a market catalyst coming up. For the core CPI, which is less food and energy, it's expected to come in at 0.4%, which is at the higher range of that, and that still annualizes out to 4.8%, which is still not that great for us. That is something that, even though inflation is expected to be moderating, and Jerome Powell comes out and says, we might see resurgences of inflation, we want to make sure that it's fully stamped out, so we'll have to keep rates higher longer. All of that stuff sounds like the market shouldn't have been rallying as much on the news as they have. And that's why I ended up closing out some of my short options that I had, options to short the market on Friday of last week. However, I still hold on to my short hedge position against the rest of my portfolio because I do expect that this CPI reading is not going to be something that's all that kind for us. I don't think that through Q2 that we see a lot of good things said from corporations about their Q1 revenues, about their earnings, about the rest of their outlook for 2023. So for those reasons, I keep a hold of that. Back to the CPI though, those values coming in. So going from negative 0.1 in December to 0.5 in January, that 0.6% difference in month over month is something that, typically you have small changes. And if you want to see my spreadsheet that I have on that is available over at the Patreon. So sign up, you get access to that, and you can take a look and see that typically there's 20% of the time. So 1 out of every 5 times, there's no change in month over month values. And that's over the history since 1947 in the CPI. When you look at that, for going just 0.1% up or down from that value that you had the preceding month, now you're covering up to like 48% of the time that you have that small move. So half the time you only make small moves. The rest of it, the other half of the time, is any other amount of movement. So small or large. And this movement that we have, this big old delta, this massive rate of change difference that we have in month over month going from December to January, according to consensus. Again, this is not an actual value yet, so we're going to have to watch and see how that comes out. But if it does happen, that only happens 2% of the time to make a move of 0.6 difference from month over month for one month to month over month for the other month. And that I think is going to be very jarring, very rattling. That only happens about once every 5 years, statistically speaking, or I should say on average. So I have some charts here. I'm going to share the charts with you. So first we have the CPI from December. We can see for all items it was 6.5%. That's in this column here. And then less food and energy is the 5.7. And then you have the month over month, which is the negative 0.1. And then we also have the 0.3 for the core. So the negative 0.1, good. We want to see more of that. Not necessarily even that it has to be negative, just 0, 0.1, 0.2. Those would be excellent bullish signs for us in the market. If we come below consensus, it is possible that the market rallies, but we still have a higher value than that Then the 0, the 0.1, 0.2, 0.3, if we do come that far below consensus, maybe party on. We'll have to look and see what the core has to say about that as well. So for the core, it does say 0.3. Consensus for January is coming in at 0.4. So that's something else that we'll remember for that. So here, this is the look since 1947 on the St. Louis Fed. You can see the chart and how much inflation has run up, especially since the pandemic. And we'll move that over to a more recent time frame so you can see just the sort of curve that we've been on. That concavity has switched to concave down, so we have rounded the top of that for the CPI, moving upward. However, some of those inflationary pressures could still exist, and that is something expected by the Fed. And then we have lagging indicators such as services that haven't quite shown that inflation is moderating for them yet, or that we have that disinflation there. And although Jerome said several times it is in the pipeline, so they do expect to see it probably in the second half of 2023. When we move over to core, pretty much the same looking graph. And really, you have to stack one on top of the other to see the difference, but core really is smoothed out more so than what we had for all items for CPI for all urban consumers. But the one I really want you to see, and I know that this looks absolutely crazy, but this is taking the month over month measures. The blue that we're looking at is core CPI. The red that we're looking at is CPI, which includes food and energy. So that's for all items, and the labels are up on the screen, so you can take a look at those. And you can see just how whippy they were over time, that the red does peak up a lot more than the blue does. So that's that volatility that food and energy add to it, and that's why it gets subtracted out, because they are volatile, to look at a steadier rhythm that we would have moving on smaller changes for core CPI for month over month measures. So if we go even closer in, just so we can see more of what's recently happening. So there's December in blue, the top number, 0.3, and then rounding up to 0.1% for the red, which would be for all items coming in at negative 0.1. So we would shoot back up just for comparison's sake. So right now where my cursor's at on the red, if we come in at 0.4%, that's about how high the blue one will go. So just below this gray line that you see here. There we go. I'll put my cursor right next to it. So we come back up about to that value, and that's 2 ticks up in inflationary measures in a row, and the Fed is looking for patterns. So that puts extra pressure on March to make sure that what we're seeing in January possibly is not a one-off thing, sort of like that jobs report that we had recently, where there were 517,000 jobs added. And then when you look at the red one going from -1, that one quickly jumps up here to exactly to where the gray line is. That is a large move up. And like I said, we only see a move that size about once every 5 years on average over the history of the CPI, 1947 to present day. I don't know how the market responds anything other than negatively if we come in at consensus. I wonder if we're just holding on for that moment, or maybe leading up to that moment, maybe even driving the markets up based on consumer sentiment, which we get Friday at 10 a.m. Those are things that we just have to watch for. Let's take a quick look at the markets and we'll wrap things up for you, and I'll give you my final thoughts. So here we're looking at the cues, and these are the support and resistance lines that I had here in my earlier video. If you watched the one that I put out yesterday, near the market close, and being within that range, we are sitting just at about support right now. Consumer sentiment, I think, and I also mentioned in my last video, I think consumer sentiment gives us a nice green day in the markets. We're going to have to watch as that comes out, especially if consumer confidence is way up above the 65 that's expected. And we got to qualify that the inflation expectations that are also reported in that consumer sentiment are also either steady or down even further from where they are. Those are things that could really help support Friday being that green day rather than a sell-off day that drops us down through the support that we're currently sitting at in the NASDAQ. Moving on to the SPY, I know I don't have my lines drawn on this one, but we are, if I put my cursor there, you can see the horizontal lines that we are pretty much sitting at this area of support based off these previous highs that we have, and we are settled. Honestly, 4,000 is going to be a critical area of support for the S&P 500. So the SPY tracks the S&P, and I believe that if you take 10 times the 470, you get 4070, and we'll even test that. We'll go look at the S&P in just a moment to see how that works out. but basically down to that $400 mark is where we could find really solid, not only psychological support, but that's also decent support. And you can see that happening across some of these other previous minor peaks that we have as well, that we tend to stall out around either for support or resistance. In this case, with the peaks being resistance at that $400 level, and breaking above that is really, really a good thing for allowing some more levity to come to the price of the SPY. So because I said we'd take a look at the S&P, you can see we have about 2% to go down to support, dropping down to that 4,000 level, which there I'll put my cursor right about where 4,000 is. So like I said, about 2% down is what we could experience between now and by Monday, prior to that CPI coming out on Tuesday. So my final thoughts. What do I expect from the CPI coming out on Tuesday? If we come out at consensus, I think it's red for the markets, and I think that it's a very negative red day for the markets. If we come out at 0.5% month over month for January as expected, I think right now there's some disbelief that it's going to come in that much higher month over month than December did, but we're going to have to watch and see that happen. So statistically, it's only somewhat unlikely. It's still within 2 standard deviations of the mean. Again, if you want to see the spreadsheet that I've made analyzing that, and also hear further analysis on that, that is available over at the Patreon. So check that out down in the description, and come on over and be part of the community and see those products, my research as it comes out, and I think you'll be glad that you did. Let's move on from there. So coming out of consensus, I think we drop further. I think we break through the support lines that we have. If we come in near consensus but just under, I think that'll be a little bit easier breathing for the markets, but I don't think that we move up incredibly from it. So that would be 0.4 for all items and 0.3 for core CPI. And if we come in way under expectations, then for the CPI for Tuesday will be a very green day, coming in well below consensus. So we want to watch for that as well. I expect that we're going to come in at consensus, or maybe even slightly above consensus. And either one of those things, like I said, we see red. So I think Friday, green day for consumer expectations. CPI on Tuesday, red for love, but red also for the markets. I think that we'll see a double whammy there. I hope that I'm wrong. For the short hedge that I have, I think that it would pay off for me very well to see that red happen. And I think it would create buying opportunities for some things that may have gotten a little bit pricier than people are willing to pay after that extended sell-off that we've had throughout 2022. So those are the thoughts that I have for you. Please check out the links down in the description if you'd like to further support this channel. At the very least, hit the like and subscribe button, and put a nerd emoji down in the comments. That is the emoji that represents me best, because I am very nerdy about finance. I'm very nerdy about working with numbers and understanding the economy, and I really, really enjoy coming onto YouTube and talking to all of you about it. So thank you very much for watching this video, sticking around to the end. Come join my Patreon. Absolutely love to have you over there. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.